Over the last 1 year, interest rates have inched higher as central banks across the world hiked interest rates to battle inflation. And while equity markets have remained volatile during this time, debt as an asset class has turned more attractive thanks to the rising interest rate scenario. Now, the big question is, should you choose debt over equity? What are the pockets in the debt space where you can invest your hard-earned money? Let's bring on board Dhirendra Kumar, CEO of Value Research, to answer these questions. Dhirendra, good evening and welcome to the show. Debt as an asset class is gaining attraction due to rising interest rate. Is it the time to have a larger exposure to rebuild? Obviously, a lot goes into portfolio diversification that one should be considering. But what about having or placing debt on a higher level in your portfolio?
Not really, any thoughtful investor should have a asset allocation plan. So if you don't have any, uh, write one for yourself. And of course, it's a good time to be investing. If your debt exposure will get a decent return. But I think more importantly, the way to rebalance, the way to review it will be the interest rate has gone up from 4 to 6.5%. And what the home buyers have not understood that their home loan has gotten elongated from 20 years to 29 years. So take a stock of things. You might be lent because when you buy debt, when you invest in debt, or fixed income, you are effectively lending, and your own borrowing has gone up. So it is time to take a stock of things, realign things. And if you don't have asset, one investor should not be a binary investor that should be in equity or should be in debt, because it is very hard to call that, take a call on that. If somebody can do it, it will be a magic, but very difficult to do it. And we have seen in the last 4 or 5 years that nobody has been able to get their call on the interest rates well. Most fixed income professional fund managers have not been able to call it right. So I would say that have your asset allocation, have a rebalancing strategy, but before that, take a stock of your borrowing as well.
All right. So, but we talk about the debt category. A lot can be looked into from the investor's perspective. What kind of debt mutual funds are we talking about? Are we looking at floater funds, target maturity funds? Maybe that can be considered.
Any passive long-term fixed income investor should not try and venture into the novel part, or the exotic part of the fixed income market. Though if you have a predictable time frame for which you are investing, then you have a lot of interesting way. Even fixed deposit could be a decent thing. But one should look at the post-tax return. And there we are getting some very handsome return, but post-tax it may not be attractive. The advantage of a fixed income fund is that you are able to defer all your taxes till you realize it, and converting your interest kind of income into a capital gain and effectively a lower tax rate. So with that in mind, and the interest rate outlook is going to be very hazy from here on. It is not going to be a very linear one, upward or downward. There might be expectation that it will go up and it will come down, or it will come down and it will go up. So uh, it isn't a very clear path as it was a year ago. So with that in mind, I would say that investors should not get venture into anything but short-term debt.
Dhirendra, what are your thoughts on municipal bonds? We recently saw that the Indore Municipal Corporation issued green municipal bonds. Do you think investors should look at these kind of debt options?
Be careful about it, because when you are buying municipal bond, you have to see the quality of that. It is fine to be, there is a novelty. They are yielding decent return. They have a cash flow backing it. But all municipal bonds may not be alike. So one should be looking at what you are getting into. It may not be, and today investors don't have the avenue of diversifying into them. So if over a period of time we have options, we have choice, and somebody is able to diversify it well, because taking this route, just don't get attracted to high return, because your capital might be at risk. Be wary of that.
All right, so this is one area in debt where one can look at diversifying, but then there are specific balanced funds also which have a certain amount of exposure of equity and debt. Do you think it's the time, this is the time when investors can look at these funds also because the debt part can actually be beneficial for them?
Yes, absolutely. The automatic rebalancing without any tax incidence makes these hybrid funds very attractive. Depending on your, balance fund, the erstwhile balance fund, which is now called aggressive hybrid fund, they are very interesting because they are almost like an equity fund and they are able to rebalance. That is meant for long-term investors, long-term, equity investor, and they get the automatic rebalancing without any tax incidence. That is one way. We don't have a decent choice of the 50-50 balance fund. But the equity income fund or the conservative hybrid fund, where nearly a fourth of the money is invested in equity, three-fourths into fixed income, that might be very useful category today for any conservative long-term fixed income investor or risk-averse investor.
But now let's talk about the comparison. In a longer term horizon, can one bet on equity funds or balance fund, or overall diversification is needed, be it equity funds or balance funds?
Yes, we have seen there are occasions when balance funds are able to beat the equity fund category by a handsome margin. Well, that is entirely because a quarter of the money, in a falling market or in a heavy market or in a market which is going up and down and not going anywhere. That's the phase when balance funds do very well. But as you know that equity does very well. It in a period time in a very narrow period of time. It could be a test of patience for a long period of time, and then it goes up. The big spurt that happens in a narrow, small time period, that actually makes the case for equity. So I think it is not balance fund or equity. The case is that if you are not used to the equity volatility, if you are not used to 20%, 30%, I don't know how many of our viewers today will recall 2008 or post 2008 market. The market went down by 70% or 65%. The Sensex went down from the high of 20,000 to 8,500. That was the time when small cap funds went down by 70%, large caps went down by 45%. That's the kind of thing which many new investors or and somebody who has not been a regular fixed, or anybody who has not experienced with market linked investment might be driven out of the market forever. I think balance, the aggressive hybrid funds or the balance funds are meant for them. It helps you stick around. But if you are used to it, if you can actually take it into your stride, then the numbers are very clear. Small caps do deliver best return over 10-year, 15-year period. The returns actually get enhanced if you are a regular investor. But the big drawdown that we see in between, that is where these funds come into play, and they also happen to be most tax efficient. One should not be doing all this rebalancing. If you have to do the rebalancing yourself, which is not very difficult, but it may not be very tax efficient. And more so now when equity is taxable.
Since you just mentioned rebalancing, so is it advisable for an investor to keep changing strategies given the change in the interest rates?
It is very difficult for an individual investor to keep changing strategy and making sense of all this. And that is also at a time when because most of the changes that happen, they are not predictable. So I would say that managing the manageable, you have a greater sense of when do you need the money, how much decline that you can withstand, what are you comfortable with. And this is where this asset allocation, a disciplined approach, rebalancing rules for yourself is more implementable. If one is able to predict these precisely, one could be a magician and actually could be very rewarding.
All right, so with the increase in interest rates, debt mutual funds definitely look attractive. Thank you so much, Dhirendra, for being on the show and taking our viewers through this. On that note, let's take a quick break, and after that, we will continue our discussion on fixed income instruments, but this time it's going to be fixed deposit after this break.